Good morning. Yesterday wasn't really a very good day for the markets. Although the Nifty did not end up losing a lot of points, but then the overall market breadth was pretty negative. It was sparked by the rumors that the US Federal Reserve will prematurely withdraw taper its quantitative easing, the monthly purchases of treasuries and mortgage-backed securities that it's been doing. It'll probably taper it off from the current $85 billion per month to probably $65 billion per month in the next or probably next to next Fed meet. Hence, also the fall in the rupee to a record low of 58.1 is also a cause of concern, especially from the CAD point of view. Although we can argue that it's we have problems in India, but then that was a pretty knee-jerk reaction for the rupee to cross the 58 threshold, and it's more to do with the global strength of the dollar rather than even more worsening fundamentals of the Indian economy. The U.S. bond yields have been rising pretty steadily in the last couple of months, again due to the same reason that the Fed might prematurely withdraw its stimulus on the back of the very good jobs data that came out last week around, and also provided support to the already fragile recovery in the US. Uh, the Eurozone also seems to be probably getting up from the worst, with the French Prime Minister also announcing that the Euro crisis is over for him. But then, as we know, Europe is not out of the woods yet, and same goes for Japan. Although the economics is starting to show some sort of positive momentum for the Japanese economy, which grew at an annualized rate of 4.1% in the last quarter. However, people believe that in the long run it will not be as productive as expected by the Japanese government and the finance ministry. Regarding the Indian markets, the government continues to say that it is trying to get maximum number of policy reforms passed out and encourage inflows in the country. However, the RBI pointed out that the inflow, the quality and the amount of inflows that is required to finance a huge CAD for the Indian economy has to be of good quality, whereas we've possibly received the so-called hot money in the last year or so. Although we've received a record inflow of FIIs, however, the money has been hot and it's not been the quality that we really want, sustainable inflow. Also, with the expansionary monetary policy, we feel that with the RBI beginning to cut rates, FI will probably flee Indian markets as interest rates come down, and they also have been battered partly by the depreciating rupee. So, all in all, things do not look bleak. I mean, they do not look so bright, but at the same time, not so bleak for the Indian economy. We feel that we are not far away from bottom, and we look forward to what the RBI does in the next policy meet. And markets are probably going to hinge on that since we are past the earnings season. Thank you.